All right, welcome to my 30 STP strategy. And just to give you a little bit of background information about the strategy, it is called the 30 STP, which stands for 30-second trend pullback, which is essentially what we will be trading. That's a little bit of background information about where the name comes from. It's very important to know for this strategy, I only use two time frames. I use one higher time frame and I use one lower time frame. The higher time frame is for the direction and the lower time frame is for our entries. It is very important to know which time frames to align. This strategy is fractal, which means you can combine different sets of time frames. If you trade futures, like myself, you can go lower in your time frame alignment, purely because you virtually do not have any spreads in futures. If you trade Forex or CFDs or crypto, you have to deal with spreads. So you cannot go to the lower time frames. The strategy works still 100% perfect. You just can't go to, let's say, the 5-minute and the 30 seconds like you can on futures. So if you trade Forex, CFDs or crypto, the lowest you can go would be 15 minutes as your higher time frame and 1 minute as your entry time frame. Also, to give you some more background information about the two time frames. So even if you trade futures, you can still decide which two time frames work best for you. If you are already used to trading on the lower time frames, then the 5-minute and the 30 seconds will probably be perfect for you. If that turns out to be a little bit too fast, you can also go up and you can use the 15-minute as your high time frame and then the 1 minute as your entry time frame. If that is still too fast, you can go up. You can use the 30-minute and the 2-minute as your entry time frame. Myself, I trade futures and I trade it on the lower time frames. So I use the 5-minute as my higher time frame and I use the 30 seconds as my entry time frame. So throughout this video, I will be using these two time frame alignments. I will be using the 5-minute as my higher time frame and I will use the 30 seconds as my entry time frame. So just to be clear again, should you trade a different set of time frames, then wherever you see 5 minutes in this video, you fill in your higher time frame, for instance, 15 minutes. And if you see the 30 seconds, then you use the 1 minute. But again, for this presentation, I will be using the 5-minute as my higher time frame and the 30 seconds as my entry time frame. Let's start at the beginning, because this is very important. It is the backbone of the strategy. Rule number 1 of the strategy is, it is a trend following strategy. It's a momentum strategy. So rule number 1 is, only trade this strategy when price is trending. It doesn't matter if price is trending up or trending down, but price has to be trending. Otherwise, you do not trade the strategy. If price is consolidating, like here, what I usually do is I draw a box around it and I wait. I wait until price breaks out of the box and gives me more confirmation that price will start trending again. So very important, rule number 1, only trade this strategy when price is trending. Doesn't matter if it's trending up or down, but it has to be trending. And with trending, I mean on the higher time frame. So whichever time frame you use on the higher time frame, it needs to be trending on that time frame. The other thing I want to call out is if you want to determine whether price is, for instance, in a trend up, you are looking for higher lows and higher highs, higher lows and higher highs. And if we're trending down, we are looking for lower lows and lower highs, lower lows, lower highs. The other thing I want to call out is how I mark my swing high and my swing low, because there are different sort of trading schools of thought. Some people make it very complicated. I like to make my trading very simple. So for me, a swing high is when the high of a candle is higher than the high of the candle on the left and higher than the candle's high on the right. The opposite for a swing low. So the low of the middle candle needs to be lower than the low of the candle on the left and the low of the candle on the right. The only entry model we will be using on the lower time frame will be the CISD model. We can also use the CISD as one of the price signatures on the higher time frame to signal us that a trend pullback on the higher time frame has been exhausted. But on the higher time frame, the CISD is not the only price signature. I'm going to tell you which other price signatures you can look out for. But on the entry time frame, literally the only thing that you need to be looking for is whether or not you get a confirmed CISD. That will be our entry model on the lower time frame. Now, what is a CISD? The CISD stands for a change in the state of delivery. It is basically a very good confirmation model whether price is either reversing or continuing. Now, in this case, we are looking for a higher time frame key level. This key level can be a session high, it can be a 5-minute swing high, it can be a fair value gap or order block, but some sort of level that price will react to. Now, with a CISD, it's always important to see which candle or candles push into this key level. A CISD can exist out of one candle or two candles or 3 or 4 or 5. If it's more than one candle, it's very important that the candles that push into the higher time frame key level, so the leg that pushes into the higher time frame key level, that the candles are of the same color. So in this case, my bullish candles are white and my bearish candles are black. This is very important. So in this case, we have two bullish candles that push into this higher time frame key level. In this case, because we have two consecutive bullish candles, we go back to the first candle. You always go back to the first candle, the candle that initiates the leg up, that pushes into your higher time frame key level. This first candle, I'm calling it the measurement candle. You always go back to the first candle and you mark out the candle body low. This is very important. Do not mark out the wick. If you mark out the wick, you are trading a market structure shift, which is a different model. So for a CISD, again, you go back to the first candle that initiates the push up. In this case, I have two bullish candles. So you go back to the first candle, the measurement candle, and you draw a blue line at the candle body open. This is your CISD line. Now, we only have a confirmed CISD when we have, in this case, a bearish candle closure below the blue line. It doesn't matter how far below. It can be like this, where it's quite substantially below. But you'll see in some of the examples, a candle can also close just below with its body. That's also okay, as long as it closes with its body below the CISD line. If you only have a wick, but not a candle body closure, you wait. Because the CISD is such a strong confirmation model, if you only have a wick and price cannot close below with its body, that often means that there is some more liquidity above you that you might not be aware of, and the chance of you being stopped out will be high. So always wait until you have a candle body closure below the CISD line. Also, do not try and front run the entry. Sometimes when you trade live, it will look like this candle is going very fast and very bearish, and you think, okay, I can enter here already because it looks like it's going to close bearish, only for it to shoot back up and close with its body above the CISD line for them to stop you out. So always wait for a candle body closure below the CISD line. Another extra nice edge within the CISD model is that about 5 out of 10 times it will give you an earlier entry than a market structure shift. Again, it doesn't happen all the time, but when it happens, it gives you a nice extra early entry opportunity, which usually means that you can also get out earlier. If this early entry CISD opportunity presents itself, you normally get out where market structure shift traders enter that trade. So you use their entry liquidity as your exit liquidity, which is nice. Another example of a CISD, in this case, we have, again, a higher time frame key level here. But in this case, we have one bullish candle that pushes into that key level. So this is your measurement candle because it's only one candle. So you go to the candle body open and you mark out the candle body open with a blue line. your CISD line. And in this case, we have price reversing, and we have a candle body closure below the CISD line, which makes this a confirmed CISD. Here's an example the other way around. So in this case, we have our key level here. We see a push down, a leg down that pushes into the key level. And in this case, it's 3 consecutive bearish candles. So this is great. So remember what I said. We always go back to the first candle, the candle that initiates the leg down that pushes into the key level. So this is the first candle. This is your measurement candle. So again, you mark out the candle body open with a blue CISD line. So in this case, you wait for this bullish candle to close with its body above the CISD line. That is a confirmed CISD. Okay, so here's an example of what you shouldn't do. In this case, we have our higher time frame key level over here. You cannot say, okay, this is one leg down that pushes into the higher time frame key level. So I'm going to mark this candle body open with my CISD line, and I'm going to leave it there. Why not? Because these 3 candles are not of the same color. So that doesn't work. And what I normally do is this. Let's say we have a session low coming up or another key level, and I do not see these candles. I only see this candle. What I normally do is I mark out the candle, this candle body open with the CISD line, and then I wait, because I always wait for price to tell me where it's going to go. So in this case, I'm getting then a bullish candle, but no candle has touched my key level yet, and it also hasn't closed above my CISD line, so I'll wait. In this case, the next candle is the bearish candle that pushes into the key level. So now I move my CISD line down from this candle to this candle body open. Why? Because now this is the candle that pushes into this higher time frame key level. So you mark it out with a blue CISD line, and in this case, the very next candle gives you a confirmation as it closes with its body above the CISD line. Sometimes it will happen that you'll get another bearish candle or another 2 bearish candles. That's okay. Then you still leave your CISD line down here, because as long as the next candles are of the same color, this will still be your first measurement candle. But in this case, the next candle already gives us our confirmation. So before you start your session, the first thing we always do is we look at the higher time frame. You always need to look back at the most recent price action. So if you trade the London session, for instance, you look back at the price action in Asia. If you trade New York, you look at the previous price action in London, and so forth. The first thing we always do is we start on the higher time frame. In this case, as I mentioned in the beginning, I'm using the 5-minute as my higher time frame. We always start by marking out our 5-minute swing highs and 5-minute swing lows. 5-minute swing lows, 5-minute swing high, 5-minute swing low, swing high, swing low, swing high, swing low. Because the first thing we always need to determine is price trending or not. Remember rule number 1. If price is not trending on the higher time frame, we do not do anything. We wait until price starts trending. In this case, we are in a clear downtrend because our swing lows continue to be broken. Now, your 5-minute swing highs and 5-minute swing lows will look like this on our 30 seconds time frame, on our entry time frame. So this is your 5-minute swing high, and this is your 5-minute swing low. 5-minute swing low, 5-minute swing high, 5-minute swing low. Now we are going to look for our trade entries in these legs down, the ones that are circled with orange. Why in these legs down? Because once you get the higher time frame confirmation, and I'm going to tell you later on what these confirmations are, once you have that confirmation, you are then trading in line with the higher time frame trend, the 5-minute trend, but also in line with the 30 seconds trend. This leg down, basically you're trading in line with 2 trends, which normally means that the momentum is very strong which makes this leg or these legs down the highest probability trades, because you are trading in line with 2 threads. Now, let's dive into some examples, because then it will become immediately clear how these 2 time frames work together. So what I do is I split my trading screen in 2. On the left, I have my higher time frame, my 5 minute, and on the right, I have my 30 seconds, my entry time frame. And again, just a quick repeat, if you use other time frame alignments, it would work, for instance, like this. Then this will be your 15 minute, this will be your 1 minute. But in this case, I'm using the 5 minutes and the 30 seconds. So remember what we always do first. We start on the higher time frame, the 5 minutes, and we mark out our swing highs and our swing lows, swing highs, swing lows, because the first thing we always need to do is we need to find out or determine whether price is trending or not. Okay, so in this case, we are clearly in a downtrend because the swing lows are being broken. Now, you always need to look at the bigger picture as well. So what you can do is draw a trend line through these points here. Just by doing that, you will see that when price is in this area, it's a logical place for price to start reversing. So always look at the bigger picture as well, because it will give you a good idea of where price might reverse. Now, in this case, we are in a downtrend. So whenever your swing low gets broken, it's very important that you wait for a trend pullback on the higher time frame. And then you wait for a price signature that basically signals you that, hey, this trend pullback on the higher time frame is exhausted, and now I'm going down. I'm going down all the way to our 5 minute swing low, which is your next logical liquidity point. Now, there are different price signatures that you can get to signal you that a trend pullback is exhausted. The easiest one to spot is a bearish engulfing candle in this case. You see, we have a trend pullback and we have a bearish engulfing candle. My definition of an engulfing candle is when the body of this candle engulfs the body of the previous candle. That is my definition for a bearish engulfing candle. In this case, this is a clear bearish engulfing candle. And I'm going to show you in the next example how we then start entering from that point on the lower time frame. But this is the easiest price signature that you can get for price to signal you that a trend pullback is exhausted and will now go down to, in this case, the swing low. In this case, we can look for a CISD because we do not get an engulfing candle. So a CISD is also one of the models you can use on the higher time frame to determine whether price is reversing or not. In this case, we are looking at this last push up. This push up consists of 1, 2, 3, 4 bullish candles. When it's a doji and the other candles are bullish, I will count the doji as bullish as well. So you could start by marking out this first candle of this push up with your CISD line. And then you wait. You always wait. You wait for price to tell you where it wants to go. Always trade what you see, never what you think. So in this case, if I'm looking for a CISD, I would mark out this candle body open, and then I would wait. Now, in this case, we have this push up. Then we have a little pullback here. And after this bearish pullback, we get another bullish candle. So as soon as this candle closes, I can now move my CISD line up from this candle to this candle, because now this candle becomes the new measurement candle. And now I'm referring back to looking at the bigger picture, because remember, if you would have drawn a trend line, you would know that price is now in an area where I'm expecting price to start reversing. So in this case, as soon as this candle closes, I will mark out the candle body open with a 5 minute CISD line. And because I'm in an area where I'm expecting price to reverse, I can now go to my lower time frame, my entry time frame. This 5 minute CISD line is this line here at the top blue line. Now here, I'm waiting for a 30-second candle to close below this line, this 5-minute CISD line. As soon as this candle closes below, that is my confirmation. That is my confirmation of the higher time frame telling me, hey, this trend pullback on the 5 minutes is now exhausted and price is now going down towards our 5-minute swing low. Now, there's a very important rule that after you get a confirmation, you wait for the first decent trend pullback before you start trading the CISD model. Now, I have a little rule for that. What I call a decent trend pullback is at least a 2 or 3 candle pullback. You will see in the next example, sometimes you get a confirmation and then you only have one bullish candle and then price starts basically continuing down. After a confirmation, you don't trust one candle. You always wait for a decent pullback before you start trading the CISD model. Later on, when we are already in the leg down, we can definitely also trade one candle pullbacks, but not after a confirmation. Now, in this case, we have our confirmation when this 30-second candle closes, and we are getting immediately our first decent trend pullback, starting with this candle. 1, 2, 3 bullish candles and 2 dojis, but because the other 3 are bullish, I will count these as bullish candles too. So we mark out the candle body open with a blue line, and we wait. We let price make its pullback. We wait until this bearish candle closes below. As soon as this bearish candle closes below our CISD line, that is our cue to enter the trade. We enter the trade right away. I usually use a market order because it goes so fast. So we market into the trade. The first thing you do, you put your stop loss above the most recent 30-second swing high, which is here. So you don't put your stop loss all the way here. After you get a candle body closure below the line, you look back at the most recent 30-second swing high, which is here. So you put your stop loss here. From that point, you measure out 1-to-1 risk to reward, because this strategy has been optimized to work as a 1-to-1 risk to reward strategy. It has the highest win rate and it's optimized for prop firm trading. Now, as soon as we get out of this trade, we can look for the next 30-second trend pullback. Because remember, that's where the name came from, the 30 STP strategy. So essentially, we are trading 30-second trend pullbacks. Now, the next trend pullback starts with this candle here. So always draw out the first candle body open, because you never know whether you get a 1 candle pullback or a multiple candle pullback. So always mark out the first trend pullback candle and then you wait. In this case, the second candle is also bullish, but now we are getting a bearish candle, but it doesn't close below my CISD line. That would still be here at this point. And then we see that after this bearish candle, we get a bullish candle. As soon as this bullish candle closes, we can now move our CISD line up from this candle body open to this candle body open, because now this becomes our new measurement candle. This is the highest counter trend candle. So in this case, this is where the real pullback happens. So we have 1, 2, 3, 4 bullish candles. So that's good. So we leave our CISD line here and we wait. Let price make its pullback. You do nothing. You wait until this bearish candle closes below the CISD line. As soon as this candle closes, that's your cue to enter the trade. You enter the trade here. You put your stop loss above the most recent 30-second swing high, which is here, and you measure out 1-to-1 risk to reward. And you would come out of the trade here. Now, because we haven't reached our 5-minute swing low, which is this line here, we can look for another trend pullback. So the next 30-second trend pullback starts with this candle, right? So we mark out the first candle body open, because we never know how far or how big the pullback will be. So in this case, we have 2 candles and price starts reversing. And as soon as this candle closes below, you have a confirmed CISD. This is also an example of a candle body closing just below the CISD line. Remember, just below is good enough. So we can now enter the trade, put our stop loss above the last 30-second swing high, which is this point now. We measure out 1-to-1 risk to reward, and we are out of the trade here. Now we have also reached our 5-minute swing low. Whenever we reach our 5-minute swing low or swing high, depending on the direction you're trading in, we always wait on the higher time frame for price to tell you where it wants to go next. Because at this point, price can do three things. It can continue down, or it can consolidate a little bit, make a pullback, and then continue down. But it can also do the same thing, consolidate a little bit, make a pullback, and reverse. We don't know that. So we always, after we reach the 5-minute swing low or swing high, we wait on the higher time frame for price to tell us where it wants to go next. That's why, again, once we have the confirmation here, this is the highest probability leg to trade, because now we are trading in line with the 5-minute trend, our higher time frame trend, and in line with the 30-second trend. So we are trading in alignment with two trends. Now, some people try to overcomplicate their trading. They start looking at things like macro time frames or fair value gaps or S&T, all these things. It's not needed for this strategy. So also don't look for it. For instance, if you were to look for a fair value gap and you see a fair value gap and you were to wait for price to tap back into the fair value gap, you would miss out on this trade. So again, very important, do not overcomplicate your trading. The only rules you will need for this strategy are the rules that I'm giving you right now. So the only thing you look for on the 30 seconds chart is, do you have a confirmed CISD, yes or no? If it's a yes, you know exactly where to enter, you know exactly where to put your stop loss, you know exactly where to put your take profit. It is literally as simple as that. Now, the other thing I want to teach you is how I size my trades. Because if you look at our one-to-ones from a point of view, this would probably be 5 points. Now, there's a bit more volatility, so now our one-to-one is probably 10 points. And here, it's back to probably 4.5 or 5 points. Now, the way I size my trades is I size my trades according to what the market gives me. Some people only look for points and they say, I will not take a trade if I will not at least get a 5-point trade. In my opinion, that is not the right way to do it, because some days you will have days where there's not a lot of volatility and price might only give you 3.5 or 4.5 point moves. So if you only then wait for 5-point moves, that would mean that you cannot trade. So that's why I don't do it like this. I will trade according to what the market structure gives me. The only thing I look for again is, do I get a confirmed CISD? Because if I do, I know that more often than not, my take profit will get hit. So what I do is I always enter the trade a bit undersized. So let's say we want to risk $100 on this trade. So I would enter the trade with 2 micro contracts. I will put my stop loss up and then look at my risk. So I always make sure that I undersize the trade so that when I put my stop loss up, that is never the full risk I want to take on that trade. So I enter the trade with 2 micros. I put my stop loss here and I see, okay, my risk is $60. Then I will quickly add 3 or 4 extra micro contracts until my risk is around $100, because then I know I'm risking $100 to make $100. Same thing here. Now the volatility has picked up. So I will enter this trade with the same 2 micro contracts, put my stop loss up. Now my risk is probably already $100 or $90. If it's $100, I will not add anything. If the risk is $90, I might add 1 extra micro contract again, so that my risk is around $100 to make $100. Same thing here. I will enter the trade with the same 2 micro contracts. I put my stop loss here. Now I see, okay, my risk is probably only $50. I will then add 3 or 4 or 5 micro contracts until, again, my risk is 100, because I want to risk 100 to make 100. Now, if you size your trades like this, that will mean that you can make the same $100 in any market condition, which gives you lots more opportunities to trade, because now you can make the same $100 in a 5-point move, in a 10-point move, or in a 4.5-point move. So that's why I size the trades like this. Let's go to the next example. So again, we always start on the higher time frame, a 5 minute. We start with marking out our swing highs and our swing lows. Swing highs, swing lows. We are in a clear downtrend. And remember, always look at the bigger picture as well. So in this case, you can, again, draw a trend line through these points. And then you would see that when price is in this area, it is a logical price for price to want to reverse. Now, we are in a downtrend. So in this case, our swing low gets broken. So again, very important, always wait for a 5-minute trend pullback to finish. A lot of people, they enter too early. They don't wait for the 5-minute trend pullback to finish. And that's how you get stopped out. So in this case, we wait for the 5-minute trend pullback. Now, we can see that there's a very big wick reaction. Why? Because price is now in this area where we expecting price to reverse. We can also see that there's been a lot of wick reactions here. So I'm expecting price now to start reversing, but I don't know for sure yet, so I wait. So in this case, I'm getting my 5-minute bearish engulfing candle. This is my sign. This is my very clear sign that price now is going to reverse all the way down to my 5-minute swing low. So in this case, we wait for this 5-minute bearish engulfing candle to close. Again, bearish engulfing candle, I look at, does the body of this candle engulf the body of this previous candle? It clearly does. So for me, this is a bearish engulfing candle. You wait until this 5-minute bearish engulfing candle has been closed, and you mark out the candle body closure with a blue line. I normally draw the line already, saves me 2 seconds from drawing a line, and I'll move the line down to where the candle body is closing. So this 5-minute engulfing candle body close line is this line right here at the top. As soon as this bearish engulfing candle closes, you mark it out. And because we are in an area where we expect the price to reverse and we have now got a confirmation, we can now move to the lower time frame and you wait until you have a 30-second candle closure below our 5-minute engulfing candle close. That candle actually closed here in between these two bullish candles. So we wait for a 30-second bearish candle to close below this line with its body, which is what it's doing here. This is just your confirmation of your higher time frame telling you, okay, this trend pullback is exhausted. I am now going down all the way down to our 5-minute swing low. So remember our rule. So as soon as you have this candle closing below and you have your confirmation, do not trade a 1 candle pullback. You always wait after confirmation for the first decent trend pullback. Remember the rule, the first decent trend pullback needs to be at least 2 or 3 candles. So in this case, this is our first decent trend pullback. It's 1, 2 bullish candles and a doji. Because the other 2 are bullish, I'm counting this one as bullish as well. So this is our first decent trend pullback. We mark out the first candle, the candle that initiates the pullback. This is our measurement candle. We mark out the candle body open and we wait for price to do its pullback, make its pullback and close below. As soon as this bearish candle closes below, that's our cue to enter. Stop loss above the most recent 30-second swing high, measure out 1-to-1 risk to reward, and we out the trade here. Now, remember what I said, like once we are in the leg down, we can also start trading one candle pullbacks, because often when the trend and momentum is very strong, you will get one candle pullbacks. So after we get out of this trade, the next candle is the first trend pullback candle again. So we mark out this first candle here, because again, we never know how big the pullback will be. So we always mark out the first trend pullback candle. And in this case, you see, the next candle is already giving us our confirmation. So we enter the trade here, stop loss above the 30-second swing high, 1-to-1 risk to reward, and we out the trade here. And now we've also reached our 5-minute swing low. And remember, whenever we reach our 5-minute swing low or swing high, we wait on the higher time frame for price to tell us where it wants to go next. Again, so that's why this leg down, once you get the confirmation, that's why this leg down is the highest probability leg, because you are trading in alignment with our higher time frame trend and our lower time frame trend. Next example is a bullish example. So in this case, always start again on the 5-minute time frame. You mark out your swing low, swing high, swing low, swing high. So in this case, we are in a clear bullish uptrend. I don't know if you are familiar with liquidity sweeps, but there are a couple of liquidity sweeps going on in this trade. So as soon as our swing high is being breached by this wick, we are getting this candle with this extremely long wick. Now, as soon as this swing high is being breached, this will become our new swing high, and this will now become our swing low. Now, if you look at what's going on, or what has been going on around this swing low, we can see that there has been a liquidity sweep here. Underneath this candle, people would have put a stop loss, and you see that this wick would have taken out people's stop loss here. So there's been a liquidity sweep here already. So I do not expect price to come back in this area. Then after our swing high was breached by this wick, we got this candle with this very long wick. Now, because I don't expect price to come back here because there's no liquidity here, and I'm getting this very long wick, you can be 90% sure that this wick low is now going to be used for a liquidity sweep. So what I do is I will draw out the wick low with a blue line, and then I move to the lower time frame and I wait. I will not do anything until I see what is happening here with this wick low. So during all this price action, you wait. You just wait. You have to wait. Sit on your hands, do nothing. Wait, 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 wait. And now I see that this candle takes out the liquidity below this wick low here. You see? There's a clear liquidity sweep, and I'm getting a very big wick reaction. That for me is confirmation enough, because I know that there is no liquidity here. I know that this was the last liquidity. I know that I'm in a higher time frame bullish uptrend. So as soon as I see this liquidity sweep and this big wick reaction, that is confirmation enough for me to now know that price will now go all the way up to our 5-minute swing high here. Seeing this and knowing this, I can now use this candle, the candle that did the liquidity sweep, I can use this candle as a CISD candle. So you mark out the candle body open with a CISD line, and in this case, you get a confirmation here when this bullish candle closes above the CISD line. This is where you enter the trade. Now, because this has been a liquidity sweep, I do not expect price to come back. So in this case, we can put our stop loss here. We measure out 1-to-1 risk to reward, and we out trade. We can look for the next 30-second trend pullback, which is this candle. Remember what I said, like once we are trading inside the leg up, we can trade one candle pullbacks, because when there's a lot of momentum, you will get a lot of one candle pullbacks. So this is your next 30-second trend pullback candle. You mark out the candle body open, and you see the next candle already gives us our confirmation. So as soon as this bullish candle closes above our CISD line, we enter the trade. Stop loss below the latest or the last 30-second swing low. measure out one-to-one risk to reward, and be out the trade. Now the next trade will be a losing trade, but it is a valid entry according to our strategy rules. Now, as you know, there is no strategy in the world that has a 100% win rate. Anyone that claims to have a strategy with 100% win rate is straight up lying. So losing trades is part of the strategy, and it's okay. As long as we manage our risk properly, there's nothing to worry about, because we know that over a larger sample of trades, we will be profitable. So the only thing you can do and should do is stick to the rules of the strategy. So I would take this trade any day, because according to the rules of the strategy, it's a valid setup, because this is our next 30-second trend pullback. We mark out the candle body open, and we have a candle closure just above our CSD line, and just above is good enough. So we will enter the trade here, put our stop loss below the 30-second swing low here, and our one-to-one would probably be around here. But in this case, we are getting stopped out by this wick. Again, sometimes you do everything correct according to the strategy rules, and the market will still stop you out. It happens. So don't worry about it. It's all part of trading, any strategy for that matter. So we also know that price hasn't reached our 5-minute swing high yet, which is this line. So after I was here, we just stick to the rules and we look for the next 30-second trend pullback, which starts here, these candles. So we're marking out the candle body open here, and we get our confirmation here. As soon as this bullish candle closes just above the line, just above is good, we enter. Now we can use this wick for our stop loss placement. We measure out one-to-one risk to reward, and we are out of the trade here. And now we've reached our 5-minute swing high. So whenever we reach our 5-minute swing high or swing low, depending on the direction we're trading in, we wait on the higher time frame for price to tell us where it wants to go next. All right, let's go into some of my trade secrets, my tools of the trade, so to say. Now, remember, I mentioned in the beginning of this video that this strategy is a price action based strategy, which is true, which means that price is fractal and you don't need to use any indicators. That's why the examples I've just shown you have no indicators. However, there is one indicator that I like to use, but only on my entry time frame, and that is the 20 simple moving average, which is the blue line here. Disregard the green line, focus on the 20 simple moving average, which is this blue line. Now, I use this indicator in two different ways. The first thing I look at is the angle that it's trending in or sloping in. If the angle is more than 45 degrees, which it clearly is in this case, it means that the trend is very strong. It means that you are on the right side of the trend. So that's already a nice extra confluence to know. The second way I use it is an even more important and handy one. I use the 20 simple moving average as my last safety net. Now, what do I mean by that? So as soon as a candle pulls back and touches the 20 SMA, I have a 3-candle rule. That rule is, if price is not back above the 20 SMA, if it's not closing back above the 20 SMA, by the 3rd candle, you get out of the trade, because then it means that you will be stopped out more than likely. So in this case, this candle is touching the 20 SMA, so you can start counting. So this will be your candle 1. Then we're getting another bearish candle, that will be candle 2, but then the 3rd candle closes back above the 20 SMA, which should then give you the confidence to stay in your trade, and you see what happens next. The next candle, boom, straight to your take profit. Now here, again, this candle touches the 20 SMA, so this will be candle 1. Candle 2 closes back above. Touches, so candle 1, candle 2, back above. This candle touches the 20 SMA, candle 1, candle 2 is bullish, but it doesn't close above yet. Candle 3 closes back above. Good. candle 1, 2, 3, back above. So you see, it's a very handy tool and rule to add to this strategy. Now, where the real magic comes in is when you combine trading 1-to-1 risk to reward and using the 20 simple moving average on your entry time frame, because it will keep you in trades like this. Now imagine you're in this trade and you don't have the 20 SMA on and you see this happening. You're going to think you will be stopped out for sure. But now we have the 20 simple moving average and we have our rule. So now we see prices going against us. Okay, this is the one that touches it. Candle 1, 2, candle 3 closes back above. So we stay in the trade. And again, you see what happens next. Straight to your take profit. Because when the trend is strong, price reacts very strongly to the 20 SMA. Now, this is a case where the 20 SMA is sloping very steep up. Sometimes it also happens that it will slowly start to slope up. That is also still okay, and the same rules apply. The only thing is that if it slopes more than 45 degrees, it just means that the trend momentum is very strong. The next thing I want to teach you is how I scale in. I do that a lot myself, but it is an art form in itself, so it requires a lot of practicing. But I wanted to give you the knowledge and teach you so you understand how I do it. Now, this is an example on our entry time frame. We are on our entry time frame. We are on the 30 seconds chart. Our normal trade would be this. We have our trend pullback candle here on the 30 seconds. We mark out the candle body open and we have a bearish candle closure below. That is our cue to enter the trade. We put our stop loss above the most recent 30 second swing high. We measure out 1-to-1 risk to reward. This is our normal trade. Now imagine we want to risk $100 on this trade. So we've entered the trade. We're risking $100 on the trade. Now, while we are in this trade, we see this pullback candle. Now, you can mark that candle out, the candle body open, and we see we have a candle closure below, which essentially makes this a confirmed CISD while you're inside the trade. Now, this is a great point to scale in. Now, you have to be very careful to not scale in too much, because the most important thing is always to be able to manage your risk. Always protect your capital. So in this case, because I want to max risk $100 on this trade, I will probably scale in a couple of micro contracts to the likes of an extra $40. As soon as I've added these extra contracts in, I'm going to manage my risk and I'm going to move my stop loss down to just above this new swing high here. Because if I do not move my stop loss, now I'm risking $140 on this trade because I just scaled in extra contracts. But by moving my stop loss down to just above this swing high, I've now managed my risk, and my risk is now again down to around $100, which is great. Now, if you were to be too aggressive with scaling in, let's say you scale in more contracts and you're scaling in an extra $100. Now, even when you move your stop loss down, your risk will still be too high and your risk will probably be still around $150. So the art of scaling in is to scale in a little bit, but not too much for you to still be able to manage your risk, your original risk that you wanted to take on the trade. Now, technically, this is another pullback candle, and you could mark it out with a blue line, and you will have a candle closure below the line here. So technically, that will be another CISD, but because you are too close to your take profit, you do not scale in anymore. When you're that close to your take profit, do not scale in. It is risky. It's not going to get you a lot of extra money. So when you're too close to your take profit, let it ride out. But here, you are still early in the trade, so this is a perfect point to scale in. Now, the last thing I want to teach you is using the tick charts as your entry time frame, as opposed to the 30 seconds chart. Now, the higher time frame, the 5-minute chart, will still be the same chart that we will be using. But for our entry time frame, instead of using the 30 seconds, we can use a tick chart. In this case, we're using a 100 tick chart. Now, what is the difference between a time chart and a tick chart? Because they are two completely different things. So a time chart, a 30 seconds chart, prints a candle every 30 seconds. Regardless of what's happening in price action, every 30 seconds, it prints a candle, which results in a lot of these weird little candles that don't tell you that much. So it generates a lot of noise. Now a tick chart, and I'm using the 100 tick chart here as an example, a tick chart works completely different. It has nothing to do with time, and it only prints a candle when 100 transactions have been made, when 100 trades have been made by other traders. Only then it prints a candle. Now, there's a big advantage to that. There's a couple of big advantages to that. The first big advantage is your chart will look much cleaner. Right, so just look at the amount of candles on the 30 seconds chart. Just look at the amount of candles. Look at how many candles there are. Now look on the tick chart of how little candles there are in comparison to the 30 seconds chart. It's almost half of the candles less from the 30 seconds chart. Now there's a big advantage to that because it makes your chart way cleaner. It makes the price action really precise and clean. And it also gives you early or extra precise entry signals. To just show you the precision of that, we can look at this last leg down, for instance, on the 30 seconds chart. If you look here, there is no pullback candle here. So there's no extra trend pullback that we maybe can take profit from. If you look at the same leg down here on the tick chart, you see there's a little pullback here and a confirmation candle. So you could squeeze in one extra trade. So it makes your charts way cleaner. So the way I've set my charts up now is like this. So on the left hand, I still have my 5-minute time chart, but instead of the 30 seconds chart as my entry time frame, I'm using the 100 tick chart. We're looking for the same entry confirmation. So we're still looking for a CISD, the closure below, CISD, closure below. That is exactly the same entry model we're using on the 30 seconds chart, but we're using it now on the tick chart, which is a much cleaner chart than the 30 seconds chart. You can also compare the tick chart to a form of order flow. Some people, you would have probably seen online, they use a footprint chart, which will display then bid and ask and a lot of numbers. To me personally, I find it very confusing. I'd rather work with a tick chart because it shows me the exact same information, but in candle format. It shows me where traders have traded the most and where traders think that price will go. So it's a visual form of order flow. One very important thing to know is which tick chart to use. If you trade Asia and London session, you use the 100 tick chart. But if you trade the New York Open, let's say the 9:30 New York Open and onwards, you have to use a 1,000 tick chart or even a 2,000 tick chart. If you try to use a 100 tick chart during New York Open, the chart doesn't know what to do with itself. It will have gaps everywhere. It cannot print candles fast enough. Why? Because New York has way more transactions than Asia and London. That's why if you trade New York session open, use the 1,000 tick chart or the 2,000 tick chart. If you trade New York close, so the last 2 hours of the New York session, you can use the 500 tick charts, which works great. So this is very important. Okay, this was basically the full strategy walkthrough. What I would recommend you to do is read through the PDF that comes with this strategy, because in the PDF, I've written down each single step in even more detail than in this strategy video. I found it very important to also give you this video because some people prefer to watch a video and hear and see me walk them through the strategy. But definitely after watching this strategy, first read through the PDF, read it a couple of times, make sure you're familiar with it. And then after that, what I would recommend you to do is go on your trading platform that you use and let's say you trade the London session, I would recommend you to then scroll back on your trading platform, scroll back at least 15 London sessions, make sure you can see the price action already. So if you do that with TradingView, don't use the bar replay function, just scroll back because you want to be able to see the price action already. Because the purpose of this is scroll back 15 London sessions, split your screen in two, exactly like I've shown you in this video. So you have your higher time frame time chart on the left, and then either the 30 seconds chart or one of the tick charts on the right, and mark out the swing highs and the swing lows on the higher time frame. Mark out the price signal telling you that a higher time frame trend pullback has been exhausted. Then on the lower time frame, mark out where you get your confirmation, where you get your first decent trend pullback, and then mark out all the trade opportunities that you would have had on the leg down, exactly like the screenshots I've shown you in this video. Take screenshots of all these backtesting sessions that you do, put all these screenshots into a setup Bible. I myself use Notion, so I put all these screenshots into my setup Bible, and it will help train your brain to recognize what it needs to be looking for. So what I also always do is before I start my trading session, I will mark up my charts, and I will spend about 5 minutes looking to my setup Bible, because it is just a refresher for my brain to tell me, this is what you're looking for. This is what you're looking for. This is what you're looking for. It's like watching a movie 100 times. When you've seen it 100 times, you know exactly what's going to happen. Doing it like this with your setup Bible works exactly the same for your brain. So I do it always before I start my session, because it will make it easier to recognize when my setup happens in real time, and it will not make me hesitate for 1 second, because I've seen it 100 times. When I see it live, I immediately enter my trade. I don't hesitate. So after you've done that, if you are a beginner trader, I would first recommend you to trade the strategy in a paper trading fashion, so not with real money. If you are not a beginner trader, I would recommend you to trade the strategy live, trade it forward, but use the smallest size that you can use. So if you trade futures, only risk 1 micro contract per trade. If you trade Forex or CFDs, use the smallest lot size you can use, and do that for at least 3 to 4 to 5 days, because I want you to first get the hang of trading this strategy live, in live trading conditions. And only when you feel like you get the hang of it and you start winning trades, only then I would recommend you to then slowly start sizing up your trades again. Only then I would also recommend you to start looking for potential scaling in opportunities. Don't start looking for scaling in opportunities right from the start. First, learn to trade the strategy 1-to-1, just with the smallest lot size or contract size, until you get the hang of it. Once you get the hang of it, you scale up your size. You can maybe start copy trading it. You can start looking for scaling in opportunities. And then from there on, it's just a matter of sticking to the rules of the strategy. The power of this strategy is it is very simple. There's a lot of people online that have very difficult strategies where you need 4 indicators to line up, or you need to have like 5 confluences before you can take a trade. What I've done with this strategy is I've simplified it back to the basics. So the only rules that you need for this strategy are the rules that I've given you in this video. Don't make the mistake to then start adding extra things to the strategy rules. Like for instance, if you traded with a 9 EMA before, don't make the mistake to then add the 9 EMA to these strategy rules. I have done all the homework for you, and the only rules that you need are the rules that I've given you. Do not add anything to the strategy, because then you start overcomplicating things again, and trading in essence should be simple and is simple. The hardest part is always the psychological part. So don't do anything stupid. Don't overtrade. Don't oversize. Don't FOMO into trades. All these kind of mistakes. The nice thing with trading this strategy on the lower time frames is that you get multiple setups per session. if you trade this strategy on the 5-minute and the 30 seconds chart, and price is trending, which is also the only time you should be trading the strategy, you will get at least between 3 and 6 setups per session, often even more. Now, it's very important to understand that I'm not telling you to then take all these trades. No, because the more trades you take, the more chance there is to start losing trades. But knowing that you will have multiple setups per session, it should prevent you from FOMOing into trades. Say that you missed the first trade opportunity, then you should think by yourself, okay, I don't have to FOMO into the next trade because I will get more setups. So then you wait for the next setup to appear. I would recommend you to only go for base hit trades, take 1 or 2 trades per day and log off. Just log off, walk away from the charts and just don't look at them anymore, because I've made these mistakes myself as well. As soon as you start or continue to look at charts, you will get tempted. You will look at something where you see an opportunity, you will take the trade, then you lose that trade. Now you're pissed off. You want to make back the loss. Then you maybe start oversizing, take another trade. Now you're losing that one too, and before you know it, you're in a downward spiral. So I would recommend you don't oversize your trades. Take 1 or 2 base hits per day. If you trade multiple prop firm accounts, copy trade these base hits onto your other prop firm accounts and log off. And do this every day. Take your trades and walk away. One last tip that I will give you is, and I do this myself as well. Let's say I trade the London session, and within the first 15 minutes, I get 1 or 2 trade setups. I'm taking them and I'm green. I will then log off, but what I will do after the London session is finished, I will look back at the charts to see where my other trade opportunities would have been. I will mark them up on the chart and I will take a screenshot of that then goes into my setup Bible. Looking back at the session is not then to tell myself, hey man, you missed out of 4 other trade opportunities. No, because I know that I will miss out on some opportunities. But it is to continue to train yourself to know what to look for. All right, I'm wishing you good luck with this. Don't forget to walk through the PDF first, read through the PDF, and then, start trading it. And I'm wishing you a lot of luck and success. Let's stay in touch. You can always say hi via DM on X, or tag me in your trades on X. Use my X handle for that, because I always like to see how people go with the strategy. So please let me know how you go with it, and wishing you good luck.